Hi there, it's Mr. Smith, and in this video we're going to be talking about income taxes. Woohoo! What do they say? Nobody wants to talk about death and taxes. We're going to talk about taxes. Taxes are something that we're all going to have to deal with at some point in our lives, so it's good to have a basic understanding of them. So let's go ahead and get started. So first of all, what is income tax? Well, it's a percentage of your income collected by the government to fund its services and programs. So normally what happens is when you're working, your employer is taking money out of your check to set aside for your income taxes. And then at the end of the year, you have to, file, well, it's usually the following year, usually between February and April. You file your income taxes and you may owe or you may get a refund depending on how much tax you have paid and how much you owe. Are there any states that do not have a state income tax? Well, we happen to live in one, Texas. Now you don't need to know the others, but I'll just mention them real quick. We have Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Washington, and Wyoming. So what do income taxes pay for? Well, lots of stuff. Things like national defense, which is certainly one of the most important things that the federal government pays for. Fire and police. Road construction. And other types of infrastructure projects, things like bridges and airports, things like that. And a lot of times the federal government works with states and they don't always pay for all of these types of things, but they'll pay a significant portion. Let's see, so what else? We have things like schools, that's a really big expense. Libraries. Parks. Again, they don't pay for all parks, but there's certainly national parks, and I think there's money that's paid to the states or returned to the states to help pay for parks. Medical research. And there's other types of research that they do. Another example would be the space program. So these are all examples of things that the federal government pays for. It's certainly, I guess you could say over the years, things have gotten more and more bloated and our government is spending a lot of money. And so that's always a debatable thing. What should they be paying for and what's reasonable? Let's move on here. What government body makes the federal tax laws? Well, of course, that would be Congress, which is made up of the two houses, the House of Representatives and the Senate. What government body enforces the laws and collects the taxes? That would be our good friend, the IRS. In fact, we want to be on good terms with these guys. So this is the Internal Revenue Service. And basically, if you don't pay your federal taxes, at some point, you're probably going to get a visit from the IRS, and you don't want them to come to your house. Let's see, your gross income. So basically, we have some terminology we need to learn here. We're going to discuss. Gross income is your total income for the year. It includes income from wages and tips. So that's basically what you're earning when you do your job. Interest or dividends from investments. So if you're earning money from the stock market and other places, and especially if you're earning significant amounts, that's something you have to put or add to your gross income. unemployment compensation, profits for a business, rental income, and game show winnings are other things that would be included in it'd be added to your income. Your adjusted gross income, also known as the AGI, is found by taking your gross income and subtracting certain allowable amounts called adjustments. And for most people, these are amounts that are paid because you're putting away money for the future, for retirement, that kind of thing. So retirement accounts, and tax deferred, that means you'll be paying your taxes later, but not right now for this money you're putting away. So tax deferred savings plans. But there are other things like interest on student loans. So you're going to get a little bit of a tax break for paying that interest on your student loans. And also if you're making alimony payments. So if somebody gets divorced, the father often, or whoever's making, carrying the load financially, may be paying alimony to the other person. Anyway, I hope that's not something you ever have to worry about. Let's see, a blank, it's standard deduction. Is a lump sum amount, so it's one amount, big amount, that you can subtract from your adjusted gross income. In 2023, the standard deduction will be $13,850. You're going to see that it's a little bit less than that for the examples we're doing because they're based on the year 2021. It's $27,700 for joint filers. That'll be mostly people that are married or cohabiting, I guess you could say. Or $20,800 for head of household. So that's maybe for a person that's taking care, maybe there's not a spouse, but you're taking care of kids or even elderly people that are considered dependents, and so that's where you would be considered head of household. What else? Let's see. Itemized deductions. Are deductions you list separately if you have incurred a large number of deductible expenses. There's only certain things that are considered deductible expenses. So that would include things like interest on home mortgages. So when you buy your own home and you're paying monthly payments, often for 30 years or maybe 15 years or something in between, each time you make a payment, part of your payment's going towards interest on your loan, and the other part, whatever's left, is paying down your loan so that you owe less. But the tax or the interest on your payment you can claim. State income taxes, of course, we don't have to worry about that in Texas. Property taxes, well, you have taxes to pay if you own a house, and those are property taxes. Charitable contributions, so that's money that you're giving to the church or whatever charitable groups you're giving money to. Medical expenses exceeding 7.5% of your adjusted gross income. So you don't just get to deduct all your medical expenses, it's anything after that first 7.5% of your AGI. Normally that's a chunk of change, it's probably in the thousands, and you don't get to claim anything or itemize any deductions until you get past that number. Taxpayers, of course, want to choose the larger of the standardized deduction or itemized deductions. it turns out that about 87% of people that file their taxes are going to take the standard deduction. And so most people don't itemize anymore because the standard deduction is so large. All right, let's move on to the next page. So let's summarize here. AGI, or adjusted gross income, is gross income minus adjustments. And like I was saying earlier, for most people, you're deducting amounts that you're putting away for retirement or some kind of a savings account for the future. Taxable income is your adjusted gross income. I'll just go ahead and write AGI minus any deductions. And for most people, it's the standard deduction, or for others, it's your itemized deductions that add up to more than the standard deduction. Now, tax credits, which we like a lot, are sums of money that reduce the income tax owed by the full dollar for dollar amount of the credits. So let's look at this. So finally, your income tax, it's basically what you owe the government for the year, is equal to your tax computation. And we'll look at that in a little bit. Basically, we're figuring out what you owe based on your taxable income. But we get to subtract any tax credits. So for example, you could find what your taxes are owed for the year based on your taxable income. And then let's say you got a $500 tax credit because of COVID or something like that. So then you would, if you owed like $2,000 and you had a tax credit of $500, you would literally subtract that and you would owe $1,500. And so tax credits are golden. We like those. Example 1, let's do an example. So Michael earned wages of $38,800. He received $540 in interest from a savings account, and he contributed $4,000 to a tax-deferred IRA. He's entitled to a standard deduction of $12,550. He paid no state taxes. He lives in Texas, and he contributed $850 to charity. So first of all, let's find his gross income. That's going to include his wages, $35,800. But notice he also earns some money from interest on his savings account. He gets to add that to his income. And so you're going to get $36,340 for gross income. Now, adjusted gross income, we're going to subtract. Again, normally it's, for most people, it's stuff that's put away for savings or retirement. So in this case, it was $4,000. So we'll take the $36,340, the gross income, and subtract $4,000. And so we're going to get $32,340. So that's our AGI, adjusted gross income. And so finally, the taxable income is going to be this amount minus this. Well, notice here the standard deduction is $12,550. The only thing he could itemize is this contribution to charity of $850. Nowhere near the same amount, so we're going to want to go with the bigger number. So $12,550 will be subtracted. And if you do the math there, you'll get $19,790. So even though our gross income was $36,340, notice our taxes are based on $19,790, which is our taxable income. All right, I would encourage you to try number 2 and then watch the video. All right, so let's see how you did. So the well, first of all, Mandy earned $89,500, received $1,350 in interest from a savings account, and contributed $7,200 to a tax-deferred savings plan. She's entitled to a standard deduction of $12,550. The interest on her mortgage was $6,500. She paid $2,100 in property taxes. She paid $1,855 in state taxes, so she definitely doesn't live in Texas. And she contributed $3,000 to charity. So in this case, we want to add up those numbers to get our itemized deductions and see if that's more than the standard deduction. But first of all, let's find the gross income. You got the $89,500 that she earned at work. But notice she also got some money in interest. So that's considered part of the gross income. So let's add $1,350. And so we get $90,850. All right, find her adjusted gross income. Now notice she also contributed $7,200 to a tax-deferred savings plan. So that amount can be subtracted. So minus $7,200. And there's a lot of times when people get to the end of the year and to help themselves out in terms of taxes and lower their tax cost, they'll put money into some kind of a savings account. There's a maximum amount that they can do that with, but sometimes they'll do that partially for tax reasons. So when you subtract here, you should get $83,650. So that's the adjusted gross income. And so finally, the taxable income. Well, let's see if we want to take the standard deduction or itemize. So the things that we can itemize would be the mortgage interest, so $6,500. We've got $2,100 in property taxes, $1,855 in state taxes, and $3,000 that was given to charity. So if you add those up, I'm getting $13,455. So you can see that's more than the standard deduction of $12,550. So this is what we want to subtract from the $83,650. So minus $13,455, and I'm getting $70,195. And so that's her taxable income. Whoops, sorry, I went off the grid there. All right, and I think I'm going to go ahead and stop here, and I'll do a second video for the last 2 pages of my notes here.